Well, for more on the markets overall, let's bring in Jeff Weniger, head of equity strategy with WisdomTree Asset Management. Thanks so much for making time today, Jeff.
My pleasure.
So you are bracing for more volatility ahead. Why do you think that's going to be the case?
Yeah, and I don't know how alone I am on that. I think there's probably a good number of us that are anticipating that. So maybe it's a contrarian view to go the other way on this. But look, the reality is, if you look at some of these, the market's internals, for example, the junk bond market had its mini blow up last year. Sometimes that gets a little bit predictive for you. If something happens in 2022 and junk ends up in the stock market in 2023, that's usually a concept. But one of the other things that I'm really focused on is, look, we got a hot labor market, at least at time zero in the United States, but one portion of that labor market is not hot, and it's real estate related credit, basically mortgage brokers who are just freezing up at this point. It's been going on for well over a year in the United States, and that's one of those things that tends to give you a leading indicator of volatility because, hey, a housing freeze generally means a recession. You have a recession, you have some people going under, that type of thing. And so I think that's something that's particularly thematic, and you can corroborate it by looking at the credit-related questions inside the NFIB survey, the National Federation of Independent Businesses, which is a small business gauge in the United States. On the credit side, they're basically saying, hey, credit is becoming more restrictive. And surprise, that's what happens when you have a central banker shock you to the tune of 450 or 475 basis points in what, 11 months? So it looks like a volatility regime for 23 and probably a volatility regime for 24 as well.
That's a weird place for your calendar, Jeff. Very high. You were looking up there. Anyways, I'm joking. But you were talking about the credit conditions. We've got a chart that you flagged about credit indicators. So maybe we can bring that one up so you can just walk us through a little bit about what we're looking at here. We have the white line is the credit indicators, which is at the bottom of our screen, and then the blue line, which is the 6-month average of the VIX. So can you talk to us about how you see these aligning?
Yeah, and can I check the calendar that's up on the roof here?
Yeah.
Well, as we do that, and remember, it's in macro, in markets, you always want to try to be thinking about what could lead something else. And it's one of those situations where all you have to do is look at a lot of this housing activity, and you can see that when we have hours declining in credit-related jobs, that's mortgage, like I said, it's mortgage brokers. That happens at time zero, and then 6-12 months later, you get your volatility because that's when society realizes you've got to crack up in this case, residential real estate. So you're looking at something like an elevated volatility regime. The days of waking up to a 12 or a 15 on the VIX Volatility Index, probably going to be gone near term, the next 12, 24 months. I mean, we're in the 20s on the VIX right now. The charts you're referencing, I know that those are rolling monthly averages, but right now the VIX is at something like 21. For a lot of the great moderation, at least the last 10 years of it or so, a 21 on the VIX was considered somewhat high, and you were really, you had a shock if you were at 30, you were high if you were at 20, and the norm was something like a 15, and now it's getting difficult to get down to a 15 again on the VIX, isn't it?
Yeah, and Jeff, you also brought up the housing market and the labor market in the U.S. and we do have another chart that you flagged as well, kind of connecting the two of these. It has the housing index, that's the white line that we're looking at, and then U.S. job openings, that's the blue line there. So tell us about why you see the connection between these two.
I'll just picture all of my charts, and it's like I'm living with these 1,000 charts that I generate. I can picture it. Look, one of the things that's an interesting notion, and I don't know whether it's just cognitive dissonance or what may be the case, is that, and correct me if I'm wrong, because I mean you're in the business, you have 100 people on the show every day. Generally speaking, the consensus is, okay, it's probably a U.S. recession in 23, maybe not, but probably. All right, so that's a consensus. The U.S. housing market is ice cold. Yeah, that's consensus. And then also part of that consensus is, oh, but mid 3% unemployment. Worst case, we get to mid 4s. well, wait a minute. One of these doesn't stand here. We have, in that case, the NAHB data, the National Association of Home Builders data, and basically everything else U.S. residential real estate or home building related, with an asterisk of the home building stocks, those have actually held up. Those are waterfall, Niagara Falls type charts. These charts are recessionary. These charts are charts that would indicate, what do you have, what is it, 11 million job openings in the U.S., that it comes down notably. I just think that this is one of these markets where we're going to have to deal with some of that surprise, that this labor shortage that persists right here in March of 23, definitely a labor shortage now. Is it a labor shortage in September? Is it a labor shortage come next March? I'm questioning it. And if that's the case, do I want to be long some of these growthier type sectors inside, say, an S&P 500 or Russell 3000? Do I want to be long semis? Do I want to be long tech? I don't know. It doesn't seem to me that's what I want to be. It seems that defensive value is the play. That's part of the bread and butter at WisdomTree. I've got some question marks on this economy, and I'm not quite sure why many other strategists aren't putting the same question marks on it.